Initial thoughts. I mean, it's pretty extraordinary that these negotiations went on despite the UK election result and, you know, a barely held together government in London.
Yeah, but they have to start anyway. Remember, the negotiation has to be over by March 2019. And it's a very long negotiation. I think we have to make that clear. I mean, the UK is exiting the EU. So a lot of people are speaking of a soft Brexit or a hard Brexit. There is nothing like a soft or a hard Brexit. It's Brexit. So they exit, and afterwards you've got to negotiate a number of exemptions, like free trade agreements for a number of industries, what happens to the passporting for financial services. This will be a very long discussion. Remember, we had something similar between the EU and Canada. It took 7 years to end up with a treaty on free trade. So we are very much in a hurry to start this negotiation, because if it doesn't start really very rapidly, then of course in 2 years it will be over and nothing will have been really settled between the UK and the EU. And it will be a very serious issue, because if nothing is decided, then there will be a standard treatment of the UK, which will be the treatment like any WTO country, which means tariffs and obstacles to trade, which will be dramatic for both the UK and the EU. So this negotiation has to start very rapidly indeed.
Patrick, if you see the price action when it comes to sterling, when it comes to euro, it's clearly been the most popular hedge against Brexit. But are you thinking that maybe the markets are discounting the possibility of another Eurozone crisis?
No, I think, well, of course, we had a very strong reaction of the sterling to the announcement of Brexit, and it continues. This is what's harming the economy in the UK. I think both from an economic and a political standpoint, this is very important, because we'll see that the UK, the British economy, will be very much weaker this year and next year. And this is due to this very large imported inflation with the weaker sterling. Inflation will go probably to like 3.5% in the UK this year, and wages increase only by about 2%. So that's a massive reduction in real income. As far as your question is concerned about the EU and the Eurozone, of course, the biggest worry everyone has is Italy. Italy is a very weak country with very low productivity gains. We have the problem with the banks. It's very long to improve that. You see these two small banks near Venice. Overall, it will cost 10 billion euros to get rid of that problem with only two banks. So it's a very serious issue. But at the same time, Europe, I think, is moving towards something different arrangements. So far, when a country was in trouble, the ECB was taking that into account. And then we had QE to make it that the long-term rates would remain at a low level. But QE will be over. Next year, I'm pretty sure that the ECB will exit QE and that Europe will transform. We have a new instrument, which will be a non-monetary instrument to take care of a country in trouble. We are discussing in Europe something which would be like a Eurozone IMF, you know, starting from the existing structure, which is called the ESM, which has an enormous potential to bail out a troubled country. So I think probably the direction, yeah?
Patrick,
yes?
Yeah, it's interesting when you say that another instrument, but, you know, when we saw the crisis in southern Europe a couple of years ago, the obvious solution was, of course, fiscal union, because you can't have that really without monetary union, but that's unpalatable politically.
Yeah, but it's not Eurozone IMF is different from a fiscal union. Perhaps you have seen this blueprint by the European Commission 2 weeks ago about merging the existing public debts in the euro area. This is absolute dream. I mean, it will never happen. You cannot merge the debt of Portugal and the debt of Germany. I mean, the ratings are too different. I mean, the quality of the debts are too different. So, but here I'm speaking of something which would be an intervention fund in case one country is in trouble. You see, what we do today is absurd. We have 19 countries in the euro area. The ECB is buying the 19 debts. Presumably, we may have one or two countries in trouble in the future. Maybe. It's not even that clear. Remember that Italy is running a large current account surplus now, which is very stabilizing. But suppose, whatever, I mean, that Italy ends up into, yeah.
I'm afraid, yes, we're out of time, but thank you so much for joining us today. Patrick Artus from Natixis joining us. He's normally in Paris, joining us from Beijing.